Last week, they expanded the eligible bar list and refinery list from something like 60 or 70 eligible refiners to, I don't know, 130 or 40, many of which are in China. I found it interesting that the COMEX would do that. Certainly not a vetted procedure.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, broadcasting from the heartland of the country in Nebraska today, as I'm on my way up to Miles Franklin headquarters and SilverFest, which is less than a week away. Fortunately, joined by Andy Schectman, owner and founder of precious metals dealer Miles Franklin, who joins me each week to dig into what's happening on the physical level of the silver and gold markets, since unfortunately you can't call up CNBC or Wall Street and getting any information there, because I don't even know if they know there is a physical market. When they hear gold, I guess they think GLD or SLV. And anyway, Andy, so that's why it's great to have you here today. And how are you?
I'm good, Chris. Looking forward to seeing you, buddy. And some strange goings on lately, and I always enjoy our conversations, get a chance to talk about what's happening.
Well, I think I'm about 6 driving hours away, picking up breakfast here in Nebraska. The people are a little bit corny, but other than that, you get you see what I did there, Skipper? Corny, corn, good. Nebraska. And then I can connect that to the silver market, because other things that people like, silver and gold. And so I'm curious, what you saw. It was a little bit of a less eventful week. I guess gold and silver got pounded, a couple of the days. But what are people actually doing? Are they buying, selling? What are they saying? What can you share with us there?
Well, the demand has been relatively constant. But I will tell you this, that in a market that's moving sideways, the attention is bypassed. People will gravitate to a market that's moving higher. They will buy on the dips and buy undervalued assets when it's moving lower. But the people who have been for a long time manipulating the market, in my opinion, in an effort to acquire tremendous and vast amounts of physical, have become experts in creating volatility within a trading range, going relatively nowhere for a period of time until it goes higher. And this has really been the playbook for a very long time, whereby we see great volatility, but if you look at the price of gold and silver, yes, it got hit hard, but we're in a tight trading range, a 6 or 7% trading range, where, call it 1880 to 1925 on a low point, and 2020 on a high point. And it's holding its ground on resistance levels, or support levels rather. It isn't busting through resistance levels yet, and it's got great volatility. And so the volatility and the relative sideways pattern over the last few weeks has, I think, maybe deflected a little bit of interest. But this is just right out of their playbook. And I think that more importantly, when you take a look at what's going on, Chris, one of the things that's really got me intrigued, they've been talking about the COMEX failure for a very long time. People have been talking about that, and signal failures on the COMEX and force majeure. Last week, they expanded the eligible bar list and refinery list from something like 60 or 70 eligible refiners to, I don't know, 130 or 40, many of which are in China. I found it interesting that the COMEX would do that. Certainly not a vetted procedure. Seems to me like they're scrambling to find metal as quickly as they can in an effort to, I think, pacify a tremendous number of people standing for delivery. So It used to be for a very long time there was a select number of refineries that were approved by the COMEX, and all of a sudden they just blew that number up by at least double. So interesting times, Chris, and I guess I would just punctuate it by simply saying all of the movement we're seeing in the market is noise. Remember, the Bank of International Settlements reclassified gold as the only Tier 1 asset in the world. And as gold goes, next to U.S. Treasuries, that is, and as gold goes, so too will silver because of their 90% correlation. But when you see the price-setting mechanism of the world, which has been under constant strain from massive deliveries over the past 4 or 5 months, which is so different from what always was. No one ever stood for delivery. Now, tons of big money, high net worth individuals, family offices, funds, they're all standing for delivery and running for the hills, getting their metal off the exchange before it's no longer available. And then you see the exchange expand their eligible bar list by a massive amount. That reeks of fear and of desperation. And I think it's just a matter of time, Chris, before things really, really get exciting. So for all of the people out there listening, I think use these opportunities of volatility to buy on the dips. Look at the big picture. When the most sophisticated traders in the world are telling you that they're reclassifying gold as the only other Tier 1 asset, when JP Morgan has amassed 1 billion ounces of silver and is no longer manipulating the market, in fact has gone long, the tea leaves are pointing for a much higher price, Chris, and I think this is just the very beginning. And this calm, this volatility, this is the time to be adding to your portfolio, not after everything has been validated by an explosion in price and a blow up in the markets. Sorry to ramble, buddy. I just had a lot to say there.
Well, it's understandable. I mean, some of the stuff that happens is mind-boggling. I did see that story about the COMEX and approving the additional dealers or whatever you would call them. And I'm sure, as is customary, the COMEX, I'm sure they issued guidance, clear explanation to their customers and counterparties so that everybody would understand exactly why that was happening. Of course, that happened too, right?
Yeah, not really. In fact, there was a lot to be left to the story. You had to kind of, if you didn't see the big picture, you would just think that they're adding some more refineries. I find it interesting that I don't know how many, 20 of the new refineries are in China, and could have sworn they just had some issues about tungsten-laced bars. So I'm not saying that's the case here. I just think that if you're going to expand it to the price-setting mechanism of the world, expand that list into Chinese refineries, you ought to do a little bit of due diligence, and kind of looks like a shotgunning process to me.
Well, I hear you. I mean, there's a lot of unusual things happening. Although I did hear a rumor that the COMEX and the CFTC, they decided to save a few bucks, actual deficit reduction, and they're splitting customer service to get that same pattern of let the stuff happen, don't tell anybody anything, and which again is why I appreciate it's nice, and I know people like hearing from you because you have access to this thing, and there's the official statement, and then of course there's what's actually happening. So what's going on?
You getting attacked by a dog there, Chris?
What's that?
You getting attacked by a dog there?
No, I'm walking the streets of Nebraska. Nibbles is calmly walking by here, although that dog, he seems like he hasn't had enough silver in his portfolio lately. So, doggy, email Arcadia at Miles Franklin. Andy will beat the retail online dealers for you. So, Andy, in terms of silver, we've seen premiums go up. They've spiked a couple of times this year. They've come back in. We hear differing reports of whether silver is available. What can you tell us there, and what are the conversations you have with your dealers?
I mean, there's product available, and we have a really nice inventory. But it's an incredibly fragile market, Chris, and hangs on by a thread. And that's I guess the one thing in this, I don't know, this country, I guess, that has always surprised me is how short people's memory are. People's memories are short. And it wasn't just but a few months ago that there were virtually no inventories available and premiums were moving parabolic. Things have slowed down a little bit. As I've been saying in our last couple of podcasts, I feel we are in the eye of the hurricane. The trailing edge is coming of that storm. We saw the front edge. And, you know, here in Minneapolis, which is a place I used to always be really proud of, and I'm not any longer. In fact, it's almost embarrassing to say I live in Minneapolis. We saw more burning and rioting and looting just last week. And I think that there's more craziness on the horizon, probably centered around an election. And so right now there is product, but it's not like there is an overabundance of product. And it's relatively, I think, it's an objective term, availability, but I'll put it to you this way. It's on a razor's edge. It can quickly change. We're one event away from there being no product. And we work tirelessly, Chris, every single day to continue to secure product from every major supplier in the industry and across the globe. It's not an easy endeavor. It's getting harder and harder and harder. And it's not what it was in March, and it's not what it was a month and a half ago. But I'll tell you that it's certainly not what it's always been. You're still paying premiums that are 2 to 3 times higher than they were in 2019. And quite frankly, I think it will be the trend that continues because there has been an awakening by the mainstream. The one constant that is so far different than anything I've experienced is the influx of new people, which continues. And people are concerned, and even people who are very mainstream oriented and have done very well in mainstream investments are waking up to the realization that an all-time high in the stock market, with 50 million people unemployed, with over 1 million new jobless claims last week, is just unjustified and doesn't seem right. And they're looking for a place of safety. They're certainly not stopping in the bond market, and they're coming here. So, look, it won't take very much interest in this market to completely blow up premiums and blow up supply. So while there's decent supply right now, by no stretch of the imagination would I say it's anything near normal. Quite frankly, we're just one event away from being right back where we were in March.
Well, I can understand that. And as I was driving through Nebraska about an hour ago, I was reviewing what Andrew McGuire shared on the show this week, which helped put things in context because, I mean, the fundamentals for silver and gold, I don't know. I mean, I guess there's a lot of ways you could think about how to price them, but perhaps with gold, all right, maybe it's the dollar we're pricing because it used to be backed. I mean, if you actually look at, I mean, any rational measure of how many dollars that are out there and what a gold-backed price would be today, I mean, it's in the tens of thousands. God only knows. You factor in that there's likely no metal in Fort Knox and missing 21 trillion. Of course, if there's 21 trillion missing that we found, God knows how much we have not found, what the Fed or Exchange Stabilization Fund. So on one hand, you know, if you look at it like that, certainly for a long time, the metals prices have been out of line. Of course, as Andrew talked about, the stuff is traded in ungodly amounts of paper. And so I was thinking, you know, what really ends that? And I think on some level, it's when the demand, you know, yeah, maybe more specifically that someone shows up for their physical and you finally reach the point where you can't get it. But what facilitates that would be really when it just becomes almost so obvious that the entire thing is a Ponzi scheme and people are pulling the plug, which seems to be really at the heart of it. I mean, yes, Corona maybe was the spark, but I mean, you already have unlimited quantitative easing. Jerome Powell confirmed hyperinflation last week. Is that a fair way of, maybe a long way, but a fair way of phrasing and summing up that it's like almost just too obvious now for people to ignore?
Well, that's what I was getting at the beginning of this conversation. The people who are pulling their metal off of the markets, Chris, are the very high-level, highly involved, intuitive, and in-the-know investors. They're the ones, like, as an example, if you look at J.P. Morgan, in the last silver delivery month, Goldman Sachs issued a ton of contracts, and J.P. Morgan stopped a ton of contracts, meaning they took delivery. I don't know the exact numbers, but look, J.P. Morgan owns roughly 60% of the market, and they're going to be the ones that know when things are going bad before anybody else. And so I think the bottom line is to see a company like JP pulling all of this gold and silver off the exchange, when you see the family offices and the high net worth individuals standing for delivery, pulling it off the exchange, when you see the COMEX expand their eligible bar list by 2 times for the first time in God knows how long, if ever. This reeks of desperation. This reeks of people seeing the end is near and getting their metal in their possession, removing counterparty risk. And so, yeah, I think that we're getting closer to that moment where there is no bid, where there is nothing to sell, there is nothing to deliver. And I think that these are the preliminary moves by the insiders who are seeing the risk and weighing it against leaving it on the exchange or taking possession. And I guess it's really important to underscore that I've been doing this for a very long time, and no one ever stood for delivery on the COMEX. Very, 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 very few. And now you're seeing massive amounts of product being taken off the exchange. Why? And the answer to me is that the people who are taking it off do not trust the exchange anymore. Well, who are the people taking it off? Well, you got the most sophisticated traders on the planet taking it off. This isn't just Joe and Susie public. These are J.P. Morgan, family offices, big investment funds, big money who are in tune and tied in more than you and I are. And they're seeing exactly what's coming down the pike. And let me tell you something. To take possession of a 1,000-ounce bar is a major pain in the ass. But I'll tell you something. If you're concerned about it not being there and you really need it, you're going to find a way around that logistical challenge. And you're going to say, so what? I'm going to deal with the inconvenience of storage because a bird in the hand is worth many thousands of ounces in the bush. And that's what you're seeing happening. Big money, in the know, freaking out and pulling their money off the exchange. Just look at the big picture, I guess, is all I'm simply trying to say. Why would they do that if it not for them seeing the inherent risk of a market that is in big trouble or an exchange that is in big trouble? And so I think that is exactly what you're saying, and it's the opening salvo, if you will. The next thing that happens is all the physical product disappears, and then it happens overnight. There won't be any advance notice, that I can promise you. The advance notice, to me, is what we're seeing right now by the massive drawdowns of inventory on COMEX and the stopping of contracts by J.P. Morgan.
Well, come on, man. If you were going to telepath part of my next question, you could have held back and still let me set up the theater. But it's a two-parter. Maybe you can give a quick answer to the first one and expand after part two. Does this end with a failure on the COMEX?
Yes, it does. A cash settlement and a failure, and I think that's coming, yes.
Okay,
Why else
so
would they
then,
expand their eligible bar list by so much? Because they already are running low and they're freaking out. And you look at how many of the contracts have rolled to December, the open interest is massive right after the election. I mean, massive. It'll blow the whole thing up real quick if they don't like the way the election went, whoever they is, they decide to pull stuff off. Real quick, this all blows up.
oh, come on now, Andy. I'm sure the next president's going to be a real inflation hawk and rein in the spending. He's going to breach the independence of the Federal Reserve and say, raise interest rates, undo the QE. Too bad.
Never going to happen. We're never going to see normalization ever in our lifetime until it's a new system.
Well, too bad we never had Ron Paul as president. But to all the kids out there listening today, just keep in mind, who knows when we'll crack this deep state facade. But that aside, I guess part two of that question, which you kind of said there's no answer, although I'll ask it anyway because I basically sat around here for the last 9 years thinking about, I don't know whether it's the mechanics, whether it's COMEX force majeure or some variant of that. But I look at it similar to Enron, where if you think, all right, this is a Ponzi scheme, the day it blows up, what would you have seen the week before, the day before, the month before? And you kind of answered it, but if you'd like to touch on that or see it in a different light, I'll let you take it from there.
Yeah, exactly. I think, it's exactly what you're seeing right now. The people in the know telegraphing the move. And I think that's not sensationalizing. I mean, just ask yourself the simple question. Why pull it off of the exchange if the exchange is the safest place to be? And the most liquid place to be. Once you pull a COMEX bar off the exchange, you're talking a major pain in the ass to sell it back to the exchange. You can't. You'd have to get it re-assayed, and you're talking, I don't know, $1,000 a bar or whatever for someone to come out and drill some holes into the bar to re-assay it. So that's not happening. You sell it back to the retail industry, fine, you can do that at a discount. In other words, the point of it is that they wouldn't pull it off the exchange and completely diminish their liquidity if it not for the fear factor being greater than the inconvenience. And I think that's all people need to really see is look at the big picture. There's no reason to completely denigrate your flexibility and liquidity by a major factor and inconvenience people to have to store this stuff themselves. A COMEX contract in silver is 5 1,000-ounce bars. You're talking almost 400 pounds worth of silver on one contract. In a bar that I used to tell people, if they can pick it up, in my office I have one as a doorstop. If they could pick it up with one hand, they could take it home with them. I have never, ever met anyone who could pick up 1,000-ounce bar with one hand. I guess all I'm getting at is that the inconvenience of taking this stuff off the exchange, to me, is all you need to see. Why would the people in the know do this if not for there being big trouble ahead? So you'll see greater examples of this in the days and weeks before something like that would happen. You'll see massive open interest before that would happen. But I think the thing of it is this. The people that are doing this are able to see what's going on in COMEX in real time. And I think they realize that the amount of silver and gold that is able to be taken off the exchange is rapidly diminishing. And so a bird in the hand is worth whatever in the bush. I think you will continue to see this trend. But I'll tell you this, every time there's been a blow up in supply in this industry where it just disappears, it's immediate. The amount of money that's out there, Chris, just in the last 9 or 10 months, the amount of money that's been thrown into M1 and then M2, the immediate money supply here, is extraordinary, trillions of dollars. And, look at it this way. All right, let's look at it this way. Let's look at it another way. Recently, the Ohio Police pension fund, decided, I think the number was $16 billion that fund is worth, voted to take 5% allocation of their money. What does that work out to? Like 800 million rather, and put it into gold. Now, if we take 800 million and we divide that into a COMEX contract of 100 ounces of gold, call it 200,000 per contract, 100-ounce contracts, right? So 2,000 into 800 million is what? 4,000 contracts, is that right? That's more than the entire open interest right now for gold for September, which is under 4,000 contracts. In other words, the Ohio Police Pension Fund, which is $16 billion with a B dollar fund, has decided and voted to put 5% allocation into gold. Each gold contract, Chris, on the COMEX is 100 ounces. Call it a $200,000 contract. 5% of 16 billion, I believe, is 800 million. Divide that into 200,000, you get 4,000 contracts. That's more than the entire open interest on the COMEX market right now. That is telling, if you will, that you're seeing very, very big money. Warren Buffett putting 2.5% of Berkshire Hathaway into Barrick, Stanley Druckenmiller, the list goes on and on. Billionaires and big funds are beginning to come into this market. And maybe that's why the big money is pulling their metal, the real metal, not the rehypothecated pretend stuff, but the real metal, the eligible stuff that's coming off the exchange. And I think that's the beginning signs of it, Chris. And so maybe it's already happening. We're just not paying close enough attention.
Well, certainly the signs are there, and I'll continue to report on them. And I appreciate you sharing this update, as always. And for folks who are interested in buying or selling physical metal, and Andy, I know we talk a lot about, and I think you have a special for us this week, which I appreciate. Although perhaps you've also just mentioned, I know you buy back metals too, and I know people wonder on that half the trade when to sell. How does that all work? And so maybe if you could mention the special and anything, if people, you know, if they are in a position where they have metal that they want to sell, what they would do with that as well.
Sure. I'll answer your second question first. Selling the product is really easy. You give us a call just like you do when you buy. We lock it in just like you do when you buy. The difference being that we either send you a UPS air bill and instruct UPS to come pick the product up at your house if the order is large enough, or instruct you on how to safely send it back yourself by registered and insured U.S. mail. It's important to note that FedEx and UPS will not insure gold and silver. The only reason we are able to send by FedEx and UPS is because of our supplemental insurance policies through Lloyd's of London and other carriers. But for the public, unless you have a dealer like myself assisting you, the only way to safely send back your product, period, is by registered and insured U.S. mail, period, 100%, unless someone like me sends you an air bill that has insurance through Lloyd's of London already attached to it. So both are options in doing business with us. Today, Chris, I have two specials for you. A continuation of last week's special of the pre-1965 U.S. constitutional silver at $3.29 over. And I'll also do limited supplies on this one. I don't know how many, but we just got in, I don't know, several thousand, 2020 Austrian Vienna Philharmonics in sealed boxes of 500. And we will do those at $4.29 over the price of silver. And there are 6 major mints of the world: United States with the eagle, Canada with the maple, Australia with the kangaroo, South Africa with the Krugerrand, United Kingdom with the Britannia, and today's second special, Austria with the Vienna Philharmonic. It's an awesome, awesome coin, and I think it's as good of a value as any of the premium coins out there right now, Chris.
Well, I hope you'll set aside a few for me. According to my GPS, I'm about 6 hours away, and especially my mom big fan of classical music, and I'm also a musician. So nice Philharmonic coin. Just has a nice ring to it. And Andy, I thank you for joining me as always. And anyone does want to take Andy up on those offers or any gold and silver services, Arcadia@milesfranklin.com, the email address. I know, Andy, you don't put, people can't buy directly online from you. You've mentioned before some of the fraud issues that are out there, although you can send any questions or pricing to that Arcadia@milesfranklin address. Yara will be happy to get you some answers. There's no pressure, just if you want to find anything out. And I appreciate, Andy, that you've set that up because that has helped to support and allow us to continue the show going. So with that said,
Chris, look,
we'll wrap up.
I know it's inconvenient for a lot of your listeners are savvy computer tech people. They would rather use online, and I get that, and I apologize for the inconvenience. That's certainly not my intention. I guess I could just sum it up by saying I believe gold belongs in an analog capacity. It's a digital world, I get it, but I think there are some things that are better suited off the grid, and to me, that's where gold and silver belong. So anyways, yeah, I appreciate it as well, but I really do appreciate these weekly talks to help, assist in you getting the word out. The level of people you have on your show is fantastic and as good as anyone out there. Kudos to you, and it's my honor, and I can't wait to see you and hang with you. So safe travels, and I'll talk to you later tonight.
Well, I appreciate that. One last note about, yes, I guess there is that step. You have to email rather than press the button, although I appreciate that for, I know the way you have Yara price things is first check the online dealers and make sure people are getting something better than that. So I guess if you're willing to send an email, make it worth people's while. And lastly, I said people in Nebraska are corny. I was just teasing if there's any Nebraska listeners out there. It's actually beautiful here, and it's nice. For the first time in months, I've been able to go into a restaurant without wearing a mask. So anyway, with all that said, we will wrap up for this week. And if anyone is interested in hearing that Andrew McGuire interview we referenced, well, fortunately, it is coming your way now.